Hey, happy Monday, everybody. It's Paul Brands with This Week in Interest Rates. We're going to cover a lot of things. We're going to talk about should you lock or should you float, meaning what's going to happen with interest rates. But if we take a look back from 2020 to 2023, history has a big lesson for you. So I hope you pay attention to that. We're also going to talk about the Feds. We're going to talk about Consumer Price Index. We're going to talk about what's happening this week that's going to impact interest rates. We're going to talk about short-term, long-term predictions. Then, of course, we're going to end it with hopes and dreams. We always end it with hopes and dreams. So let's go ahead and start with today's interest rates. Today's interest rates are fabulous. If you take a look at VA, it's 5.625. FHA is 5.5. Conventional is about 5.996%. So it seems to have keep dropping. It's going to continue to keep. Well, it seems like it. Why can't I talk? I'm having a moment here. It's a great interest rate. Jumbo is being stubborn. It's not really moving that much at 6.375. And so, the real question is now a good time to refinance? Should I buy a house now, or should I wait for interest rates to drop further, especially in light with the Fed's meeting this week, actually, and they're going to reduce interest rates or potentially reduce interest rates by 0.25%. We're going to get to that piece in a second, but let's first address, should you wait or should you lock in an interest rate right now? So if we, to uncover that, let's go ahead, and I'm going to take me out of the screen. This is the 10-year treasury going back to 2023. Now, the thing is, interest rates, it's not a perfect thing, but it tends to follow the 10-year treasury. So as the 10-year treasury goes up, interest rates go down. As the 10-year treasury goes down, well, interest rates tend to follow. So let's go ahead and bring it back up here. So you can see that there is a trend here that if you look at the highlighted section, so there's 1, 2, 3, 4, 5, 6, 7, 8 highlighted section which represent lower interest rates. After a pretty small period, interest rates tend to jump up, or the 10-year treasury tends to jump up, and interest rates follow. So here we are, we're really in that same type of pattern. But I also want you to notice, if you go ahead and take a look at that those yellow dots, rates, although they keep coming down, since August of last year, when they've hit a new floor or rates have gone down, they don't go down quite as far as they did the previous time. For example, I just took a look at my weekend interest rates a year ago, and rates were a little bit lower than they are today, believe it or not. So if history is to repeat itself, the lesson that we're going to learn here is that this is a short-term, window may close soon. So you better lock in your interest rate before you miss yet another opportunity, whether it is to refinance or to lock you into a good interest rate on a 30-year fixed rate. Oops, there it is. All right, let's keep moving on here. Let's go ahead and talk about the rate cuts ahead. So this week, the Feds are, I can't talk today. The Feds are expected to reduce interest rates by 0.25%. Remember, interest rates today have already built that 0.25% interest rate into it. So there's no use in waiting until they actually do that. What could change 30-year fixed interest rates is any deviation from the plan. For example, if they cut more, then I can expect interest rates to go down. If they cut less or don't cut at all, that can really rock the 30-year fixed rate market and send interest rates back up. In fact, at the end of this, I'm going to share with you the little MBS highways, the bond market in real time, and you're going to see here in a second that interest rates, in general, have a lot more momentum to go up than they do down. So that's so pay attention to that for all you guys out there. Consumer Price Index, I'm having a hard time catching a flow here, came in as expected. Headlines 2.9, year over year is 3.1%. Remember, the target rate was about that 2.63%. So there, no real movement on inflation there. So that didn't really help or hurt interest rates. But this week, as you know, it's a big week here. The biggest thing is coming out is Wednesday's Fed meeting. Are they going to reduce it 0.25% like expected? What are they going to do? Are they going to do more? Are they going to do less? That is something that we just want to make aware that that could change interest rates, good or bad. Short-term, long-term predictions here. So for the short term, this is this week, the NBA Mortgage Banker Association expects 30-year fixed rates to drop about 15 basis points, and so does Fannie Mac. Keep in mind, I want you to notice the rates they're putting there. Lenders have everything priced so cheap right now because it's starting to get competitive. Rates are already lower than that. So my message I'm telling people is I do actually expect interest rates to go up based on the slide, the 10-year Treasury since 2023. And here, let me bring back long-term projection. Long-term, Fannie Mae expects 6.5 by the end of 2025, 6.125 by the end of 2026. I mean, we're already there. In fact, we're lower than there. So unless they start adjusting these predictions, interest rates might start trending upward. So, if it were me, I would lock. I'm not a betting man. I love lower interest rates. Rates are really good right now. And in fact, right now is a great time to bring up the bond market. So what you're taking a look now is you're looking at MBS Highways bond market. I want to share with you. So this is not the 10-year Treasury. This is the actual bond, and this works in reverse. So as that curve goes up, interest rates go down, and as the curve goes down, interest rates go up. So I want you to notice here. Let me bring this up, this up here. So we're trading in this little narrow window right here. And just to kind of really simplify this is if you can kind of envision a ceiling and a floor, it's going to bounce out up or down one way depending on the news. So usually news will make it break that way. But notice how much room the bond has to go down, which is going to push interest rates up. And even if we burst through this Fibonacci level, there's really not all that room to go up. So right now we're sitting at a great spot with interest rates. Don't get greedy. Lock in those rates. If you're in contract and you're floating, I would personally lock. Now, I hope I'm wrong, but remember, it's the exception to the rule that the bonds are going to continue their improvements, not the actual rule. So, all right, you guys, you know how we always end it here. We end it with hopes and dreams. If we are not working together, let me bring that to the stage here. If we're not working together, we should. Let's do what's called a hopes and dreams, where there's no credit pulls, there's no applications, there's none of that crazy stuff. It's just put together a game plan with myself and you and your family. I'm going to share with you how to save money. I'm going to share with you how to get your offer accepted. By the way, if you're not right now a real estate agent, that is the key piece to getting your offer accepted and getting credits for your closing costs. If you're not working with a great real estate agent, we have the best. I would love to recommend a few. Give me a call and I'll connect you with a real estate agent that will get the job done for you. With that, Paul Brandt's clear to close brokers.